Imagine a world where a country's money is collapsing, its bond market is breaking, and the central bank is forced to choose between them. Now imagine that country is the world's biggest creditor, and its struggle could push your mortgage rates higher, make your groceries more expensive, and even impact your 401k. That's the reality Japan faces right now, and the tremors are already reaching your wallet. Welcome to the Alpha Brief. I'm Marcus Reid, and if you're new here, we follow the money so you don't have to. Today, we're going to prove how a looming financial crisis in Japan could directly trigger a shockwave through the global economy, hitting your wallet harder than you expect. This isn't some abstract economic theory playing out in a far-off land. No, this story lands directly in your life. If you own a home, the rising interest rates in Japan could ripple through global bond markets, pushing your mortgage rates higher, making that monthly payment even more of a squeeze. If you're carrying any credit card debt, those rates already painful could climb further as the cost of borrowing money globally inches upward. For your 401k, that portfolio you've been building for retirement, it's partially built on this very same borrowed Japanese money. And when that money comes home, those asset prices, the tech stocks, the bonds, even Bitcoin, they could feel the pressure. And if your paycheck hasn't moved much in the last few years, get ready for inflation to keep eating away at its value, making every trip to the grocery store feel like a gut punch. Now, in the nerdy world of economics, they say there's supposed to be two types of economies, but in reality, there are actually four: the developed, the undeveloped, Argentina, and Japan. And that's because Japan has broken every single rule of economics and somehow still got away with it. For decades, Japan has had more government debt relative to the size of its economy than any developed country in the world, over 200% of GDP. Think about that for a second. That's more debt than Greece had when Greece collapsed. It's more debt than any country that's ever hyperinflated. Every textbook would tell you a country like that should have collapsed decades ago, but Japan somehow did not. Back in the 1980s, Japan was what they called a miracle economy. At one point, the land under the Imperial Palace in Tokyo was actually worth more than all the real estate in California. But then in the early 1990s, that bubble popped, and Japan went into something no modern economy had ever experienced: 3 decades of deflation. The price of stuff did not go up, and their incomes didn't go up. So to fight it, the Bank of Japan lowered interest rates to zero and basically just left them there for 30 years. Money in Japan, it essentially became free to borrow. And when money's free to borrow, a 200% debt to GDP ratio doesn't really matter, because the interest cost of having that debt is basically nothing. Now, there's a second crucial reason why Japan never collapsed, and it has everything to do with who Japan owes all that money to. You see, when Greece collapsed, they owed money to foreigners. When Argentina defaulted, they owed money to foreigners. Foreign countries and investors, they panic. When they panic, they sell their assets, and that's when it's game over for that country. But Japan, well, Japan owes the money to Japan. The Bank of Japan itself holds about 48% of all Japanese government bonds. The central bank literally owns half of its own government debt. Japanese insurance companies hold another 20%, Japanese banks 14%, and foreigners own less than 8%. This internal ownership structure meant that when things got tough, there was no foreign panic selling. Now, here's why that internal ownership and Japan's unique monetary policy is so important to Western nations and your own portfolio. While the rest of the world spent the last 20 years printing money like it was going out of style, Japan did not. Since 2004, the US money supply grew by about 280%. Canada's grew by 370%. But Japan's, it only grew by 90%. Japan was the only major economy in the world that kept its money relatively scarce and its interest rates at zero. That combination, scarce money and free money, created something called the yen carry trade. The yen carry trade meant if you were a hedge fund or a bank or a savvy investor, you could borrow yen at 0% interest, convert it to dollars, and then you could buy basically anything in the world that paid you more than zero, meaning you could buy US treasuries paying 4 or 5%. You could buy tech stocks. You could buy Bitcoin, anything you wanted, and you essentially made free money. That's estimated to be worth trillions of dollars of investments all around the world, all funded by borrowed Japanese money. But Japan was like, hey, we want to get in on this too. So Japan took its own savings overseas because for 30 years, there was nothing really worth buying in Japan. Japanese pension funds, insurers, banks, households, they all shipped their money overseas to get some of that interest. And in the process, Japan became the world's biggest foreign holder of U.S. government debt, holding something like over $1 trillion of U.S. treasuries. Japan's pension fund, for example, the GPIF, which is the biggest pension fund in the world, holds hundreds of billions of dollars in U.S. bonds and stocks. So, think about it like this. When the U.S. borrows money, when tech stocks go up, when Bitcoin goes up, there is a strong chance that somewhere in that process, it was partially funded by Japanese money. But remember, this entire system, this massive $1 trillion carry trade and global investment flow, it only works because interest rates were zero. And now, they are no longer zero. Japan's interest rates are going up, and because of that, the economy is starting to break. That means the game is changing, and the money that flowed out is being asked to come back home. It isn't just a tweak. It's a fundamental shift in the plumbing of global finance. So here's how Japan's economy is starting to break and why it matters to your financial life. Remember that 0% interest rates were only possible because of the unique circumstances Japan was in. Specifically, prices in Japan never went up, which means when inflation is zero, you can keep your interest rates at zero forever because everyone's happy. The government can carry infinite debt for free. The world could continue borrowing cheap money. Everyone's getting richer and no one's complaining. Okay, so then what changed? Why did they have to raise their interest rates? It's because of something that happened in 2020. That was the pandemic, which led to trillions and trillions of dollars flooding the market. There were broken supply chains, right? Energy prices went way up and the whole world got inflation. By 2022, Japan got 2% inflation for the first time in decades. So the Bank of Japan is like, okay, we've got some inflation, what do we do? All these other countries are raising their interest rates to fight inflation. Oh look, the US raised interest rates to 5%. That's a lot. Europe's doing it. Canada's doing it. What do we do? I know, let's not raise interest rates. We also have 200% of debt to GDP. Let's do nothing. Let's not rock the boat. Japan held their interest rates at zero and hoped that inflation would just go away. That decision started to break their money, the yen, because think about what happens when the US pays 5% on cash and Japan pays zero. What happens is money continues to flow out of the yen and into dollars. There is no demand for yen, so the strength of the yen collapses from around 110 per dollar to 150, then 160. That might continue working if the country was self-sustaining, right? But Japan almost has no natural resources of their own. They make arguably the best culture in the world, right? The best food and Pokemon cards. And I personally love Japan, but they don't make their own oil, right? They import almost all of their energy, and all of it is priced in dollars. So a collapsing yen means everything that Japan buys from the world gets more expensive for them, which means more inflation, which means more pressure on their yen, and all of that pressure eventually leads to the biggest change that economists thought would never happen to Japan. That change was a change to their psychology and culture. What does that mean? It means people now want a pay raise. You see, for 30 years, Japanese workers never really asked for pay raises because mostly that's a Western idea. Their prices never went up, so why would you need a pay raise? 0% inflation froze Japan's need for pay raises. But once inflation started to happen, workers started demanding those pay raises, and they started getting them. In fact, they got the biggest pay raises in over 3 decades. And once wages and prices start chasing each other higher, it's really, really hard to sort of put that genie back in the bottle. But then things started to get even worse, because the world got this oil shock from the war in the Middle East, pushing energy costs even higher. And they got a new government in Tokyo that wanted to spend even more money, meaning they wanted to issue more bonds, aka more debt, at a time when they already have an insanely high debt to GDP. So now Japan is at a crossroads. They have 2 options. Option number 1, keep rates at zero, keep their high levels of debt manageable, and watch the yen get destroyed. Watch inflation eat the retirees' savings. Basically, watch a country of savers get poorer every single month. That option could eventually lead to a revolution. So you have option 2, increase interest rates to save the yen. Now picking option 2 means that 200% of debt to GDP, that starts accruing real interest. The bond market that's been asleep for 30 years starts to wake up. The Bank of Japan, remember, owns half of those bonds, so they'll start bleeding losses on their own balance sheet. They need to start paying interest on their very high levels of debt. There's no third option where everything stays the same way that it was before. So the option is save the currency or save the bond market. Choose one. Now what's interesting though is that Japan actually tried an option 3, where they increased their interest rates just a little, and they intervened a lot. And they got the worst of both worlds. The yen started going down and bond yields started going way up. Bond market broke at the same time. Let me show you what that breakage sort of looks like. First, let me start with their money breaking. The yen. As I'm recording this, the yen is trading at about 160-ish yen per dollar, which is also the lowest level that it's been against the dollar in about 40 years. The last time this was happening, Ronald Reagan was president and Nintendo had just come out. Banks like JP Morgan are saying that 164 yen per dollar is kind of like a magic line in the sand where Japan will supposedly not allow the yen to fall past. As of today, we are very close to that line, and depending on when you're watching this, it could have already crossed it. So that's how their money is breaking. But now, let's look at how their bond market's breaking. In 2022, Japan's 10-year government bond paid just 0.25%, a very small amount. Today it pays about 2.7%, which is more than 10 times higher in a relatively short period. The 30-year bond is at about 4%. And I know that those numbers seem small compared to US interest rates. But remember, this is a country with over 200% debt to GDP. Every one of these percentage points applied to a debt of this size is a huge amount of money in interest. But Japan also has a weird paradox that's happening. Recently, inflation came in at 1.6%, which is good. It's below the Bank of Japan's target. So, what does this mean for your wallet? Right here, right now. This isn't a distant earthquake. It's a tremor moving through the foundation of your financial life. If you own a home, or you're planning to buy one, the unraveling of the yen carry trade means that trillions of dollars of Japanese money that was effectively propping up demand for US bonds, is now being asked to return home. When a major buyer like Japan pulls back from the US bond market, demand falls. When demand for bonds falls, their yields, or interest rates, have to go up to attract other buyers. This directly impacts long-term rates like your 30-year mortgage. So as Japan struggles to save its currency or its bond market, you could see your own mortgage rates tick higher, making homeownership even more expensive. For your savings, if you're a saver who relies on interest income, this could be a mixed bag, but mostly bad. On one hand, higher global interest rates might mean a slightly better return on your savings accounts, a point or two more. But on the other hand, the underlying cause, global financial instability and the unwinding of massive debt, carries significant risks. Inflation fueled by a collapsing yen and rising energy costs will continue to erode the purchasing power of those savings. That 1.6% inflation in Japan, which is still below the Bank of Japan's target, is just one data point. The global inflation picture, driven by rising energy prices and supply chain issues, means your dollar buys less at the grocery store, even if your savings account earns a little more. At the grocery store and the gas pump, Japan imports almost all of its energy, priced in dollars. As the yen collapses, those imports become more expensive for Japan. This isn't just a Japanese problem. Global energy markets are interconnected. If a major economy like Japan is struggling to pay for its oil, it puts upward pressure on global energy prices, and higher energy prices mean higher transportation costs for everything you buy, from your food to your clothes. So what happens in Tokyo with the yen? It means more expensive gas for your car and higher grocery bills for your family. For your paycheck and job security, the trillions of dollars in global investments funded by cheap yen, in tech stocks, in US bonds, even in Bitcoin, have fueled growth and asset prices for years. When that money is recalled, when those investments are unwound, it creates a liquidity crunch. Companies that relied on cheap financing could face higher borrowing costs, leading to slower growth, hiring freezes, or even layoffs. This isn't a guarantee of recession, but it adds a significant headwind to an already fragile global economy. The ripple effect of a major creditor nation recalling its funds could tighten credit markets worldwide, making it harder for businesses to expand, ultimately impacting job growth and wage increases. For your 401k and investment portfolio, the yen carry trade was a massive tailwind for global asset prices. When you could borrow for free and invest anywhere for a positive return, it created a flood of capital. Now that flood is reversing course. The GPIF, the world's biggest pension fund, holding hundreds of billions in US bonds and stocks, is one example of the Japanese money that has found its way into your portfolio. If Japan is forced to liquidate some of these foreign holdings to support its own currency or bond market, it could mean downward pressure on the very assets you hold in your retirement account. This isn't about panicking. It's about understanding the interconnectedness. Your portfolio is not an island. Now, I don't know exactly how this plays out, and nobody does. Maybe it resolves smoothly. That's possible. But the physical evidence, the bond market, and 50 years of history are all pointing the other way. My read of the evidence suggests that Japan's forced choice between saving its currency or its bond market will have profound implications for global liquidity in the next 6 to 12 months. We're going to see a significant unwinding of the yen carry trade, leading to higher borrowing costs, a tightening of credit, and downward pressure on asset prices, especially those that benefited most from cheap money, like certain tech stocks and even cryptocurrencies. Japan's unprecedented move to demand its wealth return home is not a minor adjustment. It's a seismic shift that will reprice risk across the board. The number I'm watching is that 164 yen per dollar line in the sand that JP Morgan mentioned. If the yen crosses and stays consistently above that level, it signals a deeper crisis that the Bank of Japan is struggling to contain, and that's when the global ripples will truly become waves.